You mentioned we're in a big bubble. Can you elaborate on that, and how is this likely to play out? When you print money on the scale such as the one in which the modern nations are currently printing it, countries such as Japan, the United States, Europe, and etc., we're getting in a new territory. In terms of size, there's never been anything like what we're doing now, and we do know from what has happened to other nations that if you try to print too much money, it eventually causes terrible trouble, and we're closer to terrible trouble than we've been in the past. This is a conversation of Charlie Munger, right-hand man of the legendary investor Warren Buffett and the vice chairman of Berkshire Hathaway, with one of the interviews on a news channel. Could it be that we're entering another market crash? Investors like Mark Cuban, Robert Kiyosaki, Warren Buffett and Charlie Munger have all hinted toward a market crash that is going to be unprecedented in its destruction. Why should we expect a market crash anytime shortly? And what necessary steps can we take to protect our money from turning into ashes? In this video, we're going to talk about the next market crash and why we should expect it. Welcome to 5-Star Finance, the place where we teach you how to achieve financial freedom. So like it or not, there's one thing that has been on the mind of every stock market investor, and that is the next market crash. We all know that the S&P 500 is already down more than 18% in 2022, after hitting its high in early 2022. No doubt that the first half of 2022 has been a bumpy ride for all value investors, but the S&P 500's downfall in 2022 is still far away from the devastation it endured in February and March of 2020. Well, if that has you thinking, let us not forget the 50% downfall the blue chip index showed during the crisis of 2008. According to the legendary investor Warren Buffett, the years ahead will occasionally deliver major market declines, even panics that will affect virtually all stocks. No one can tell you when these traumas will occur. Let us jump into understanding how an average market crash takes place. Now, a stock market is a place where people buy stocks and people sell stocks. Every market contains some buyers and sellers. With that being said, the companies can be the sellers, and by owning a stock, an investor is actually buying into the company. But occasionally, due to some reasons, panic takes place in the stock market. It can be the policy changes made by the Fed. It can be some macroeconomic conditions, like the oil prices rising substantially and the Russia-Ukraine war. There is something that causes people to freak out, and eventually it has a toll on the stock prices. To put things straight, periodic price downfalls and cyclical turns are a regularity in the stock market. But the unfolding trend so far in 2022 has many investors thinking, the next big move for the stock market can take the prices even lower. And let's just not forget that the S&P 500 is down 20% already, which tells us that we have already entered a bear market. According to Mark Cuban, one of the biggest factors that is contributing to a stock market crash is inflation. The most recent stats revealed that inflation is up already by 9.1% as compared to last year, and that is quite frightening because this is the largest increase in inflation since 1981. Now, as most of us already know, the Fed chair, Jerome Powell, told the US Congress that the Fed is working to get inflation under control. But on the other side, they're constantly raising the interest rates, which could be bad news for stock prices. Interest rates are vital for growing companies as they invest this money in their growth. And that also means if companies have to borrow money, it will come at an increased interest rate. For example, the S&P 500 companies showed significant growth of more than 45% in the year 2021, and many investors were looking for something alike in the year 2022. But that was not to be, as the index showed only a growth of 4.7%, and that was because of the interest rates imposed by the Fed. Many analysts are expecting stock prices to plunge further. Now, it's no secret that everyone knows Michael Burry had already predicted a market crash in 2022. And now his actions are backed by his words according to the recent 13F filing. Michael Burry has been one of the most talked about investors in the market, and rightly so, because the guy is certainly not afraid to share his opinions and thoughts regarding the economy. Over the past few months, he has repeatedly hinted at a gigantic market crash. But what's even more interesting for people like us is that Michael Burry, with over $100 million in assets under management, has to show his holdings due to the 13F filing. After its recent fall in June, the S&P showed slight growth, which caused investors to believe that the crash is not happening anytime soon. But the shock came when Burry termed it a short-term bear market rally. He went on to relate this market position with the tech bubble back in 2001 and the recession of 2008, and interestingly, similar events had taken place. Backing his words, Burry took some serious action with his portfolio, selling literally every stock that he had in his previous filing. Holdings like Google, Stellantis, Warner Brothers, Meta, and he even held a shorting position against Apple. But the latest filing shows us that he has sold literally every stock. According to one of his tweets, as I said about 2008, it is like watching a plane crash. It hurts, it is not fun, and I am not smiling. So what does this mean for us everyday investors? Many people will argue that Burry always focuses on short-term prospects, and many will make an argument that his positions are not even focused on the middle term, let alone the long term. According to the greatest investor of all time, Warren Buffett, market crashes should be taken as opportunities to buy some undervalued stocks. We all know that Buffett rarely changes his long-term investing strategy, also known as the buy and hold strategy, and that goes a long way in explaining why he has been so successful in the stock market. Buffett wants value investors to focus on the quality of the business or the underlying business model. A market decline presents investors with opportunities to buy some stocks at cheap prices. As long as the business model is stable, the market conditions should not bother you. As far as Buffett is concerned, during a market crash, he always focuses on good fundamentals and intrinsic business value rather than the actual underlying share price. Other than that, investors can always see Buffett making concentrated purchases, and that we mean that instead of pecking here and there like ordinary investors, he buys millions of shares of solid businesses at a reasonable price. Another thing about his investing strategy is that Buffett does not look to invest in tech stocks because he believes that he does not understand the underlying business for most of these tech stocks. For example, he simply avoided investing in tech stocks even during the dot-com boom. Another reason for his negligence around the tech stocks is that he didn't believe that these companies had been around for long enough and they just couldn't justify their business models to Warren Buffett. To put a long story short, Buffett's strategy during market downturn has been to look for those companies with good business models and reasonable prices. And for that, all the value investors need to have a great understanding of all the stock categories. As long as you don't understand the stock categories in detail, you're going to struggle to find quality stocks during times of uncertainty. This is the reason we've provided you guys with an ebook in the comment section below, which will explain the 6 stock categories in detail. And do you know what's the best part? This ebook is completely free and you don't have to pay anything for this. Check out this video we handpicked for you, and we'll see you in the next one.